Thank you, Rahul, for having me here. As Harshpai has mentioned, that rupee is today under speculative attack, and if you don't intervene, then there is chance that prices make their own fundamental. Hitherto, RBI has always intervened in the market to control the volatility, not to set the level of rupee. And by and large, that policy has worked well for us. Of course, there are periods where RBI has to intervene to ensure that rupee remains near its real effective exchange rate. It doesn't become too much overvalued. It doesn't become too much undervalued. This strategy has worked well for India, and RBI should continue to intervene for managing volatility, but not to set the level of rupee unless until it becomes extremely oversold.
So what is the effective exchange rate that it should be at?
It's an art, not a science. RBI itself publishes its data of real effective exchange rate, where above 100 it becomes overvalued, below 100 it becomes undervalued. Right now we are somewhere around 101 based on March data. April data we might be near 100. So we now are around our fair value from a real effective exchange rate point of view. But market is like a pendulum. It does swing around REER. And as Harsh mentioned, rupee right now is under speculative attack. RBI has, in all fairness and transparency, disclosed its short forward position. In many countries, people do shorting by front and not at the central bank account. But fair enough, we have been transparent in disclosing information that has created speculative attack apart from what Harsh mentioned. And hence RBI is intervened to ensure that rupee doesn't become too much oversold is also a necessity.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.